Hello and welcome to Pro Trader Strategies market commentary for Tuesday, January the 28th. Yes, it's turn those hands around. Turn around Tuesday, it looks like here, as most markets are making a sharp bounce from where they were yesterday, whether it's on the upside or the downside, which is what we were seeing mostly across the board yesterday, right? Let me talk about some economic data where I talk about the economic data, how it's going to impact those overall markets, and then we talk about our option strategies and how we're going to take advantage of some of those assumptions here. All right, without further ado, across the pond, not really a whole lot to see here. We did get the Spanish unemployment rate. It downticked just albeit slightly from 14 to 13.8. Back here in the United States, we got some really good economic data here. We got core durable goods orders. That strips out transportation items, cars, automobiles and cars, same thing, right? And airplanes, stuff like that. That came in at negative 0.1%, expected to be a positive 0.4%. Last month's number was also a negative reading as well at 0.1%. And both of those numbers were expected to be higher, so not really a great sign there. We did get durable goods orders where we add in those transportation items, and that one, boom, knocked it out of the park at 2.4%, expected to be 1.2%. Remember, last month's number was a negative reading of 2.1%, so pretty disappointing there, but nice move on this reading today. We also got Richmond Manufacturing Index coming in at 20, expected to be a negative 3. Last month's number was a negative reading also, so this is a nice recovery there. One thing to note, though, we're going to be talking about this here in a minute. I'll wait to talk about that, actually, getting ahead of myself. CB consumer confidence came in at 131.6. That one higher than the expected 128.2. And last month's number was revised up nicely from 126 to 128.2. So nice revision there, and nice beat on the headline number there with the consumer confidence number. So we also have Williams speaking, but I don't think he's really going to talk about monetary policy because today is the first of two-day meeting. Tomorrow we have the FOMC actually rate whether or not they're going to raise interest rates or lower them. They're going to expect it to be kept at 1.75. So no change there. It's really going to be about their statement, to be quite honest. Another thing to note is it doesn't look like most people are expecting a rate cut, and that's not until November of 2020. That number keeps getting pushed out. So it doesn't look like anything is probably going to happen with that number. But we'll talk about something more with rates here in just a second when I get to that. But let's say crude oil here making a bounce up about 67 cents. Remember, yesterday we were breaking below that value area low. I talked about it. Looks like there's some support there. Now we're getting a recovery and a bounce back. I think we're going to head back up to the mid-50s. I think 60 is way out of the question, especially with the global markets the way they are. There's a glut of gas out there in storages, so it really can't have that sustainable rally as far as I'm concerned. So we're kind of priced in very close to where I think is the sweet spot, in and around that $56 a barrel is where I think that the market's going to want to kind of migrate and stay around. All right, then we've got gold futures coming off today with the broader markets. We're seeing these levers and pulleys happen. Yesterday we saw gold rally when the equities were falling out of bed. Now today we're seeing some equity recovering, and gold is suffering from that. I have a gold position on that's bearish that was being tested in GLD, so I'm glad to see this market start to come back off. Then we got bonds. They're coming off again today, or why do I keep saying that? I don't know. Coming off today after yesterday's big move higher. Now yesterday we were talking about this. I have on TLT to the upside, and I'm going to talk about that a little bit later. But one thing I want to talk about here right now is this whole bond move that we saw. We saw usually what we see here with interest rates. And let me go to a white one. If we kind of look at the yield curve. Okay, so we got the yield over here and we've got maturity here. In and around, what we usually see is that rates have a tendency to go higher as we go further out the curve. Now, something that we talk about here in this this type of situation with maturity is that we see that the interest rates right now with the 3 years and the 10 years, and then we got maturity here is an inverted yield curve, which means that the shorter term interest rates are higher than the longer duration interest rate. So that's called the inverted yield curve, that smile there. That signals recessionary future expectations. So something to note here, we saw this happening today. We saw it a little bit last year as well, and we started seeing recessionary traits happening with the economic data. So we are going to have to keep an eye on that as well for future expectations. But some of the economic data we saw come out today may cause that to flip a little bit back to normal yield curve. All right, VIX is coming off. It's down 2 points. We're still in the teens after yesterday's spike. Off that big sell-off in the Dow and the rest of the broader equities, most of that having to do with the coronavirus and some other negative news that we started seeing come out. Today we're seeing a bit of a recovery. I talked about this. If you got a financial advisor out there calling you up saying, hey, we need to buy some stocks or dollar cost average, I don't know that we're out of the woods yet. I think that the idea right now would be to do selling puts or cash secured puts, something along those lines. That way, if we have a recovery, you're not, put out really that much. You're going to be actually being able to collect a credit way down here. And if we have that correction, that would be a nice correction level to be buying at. All right. So that's what I would suggest. And if you guys are managing your own money, that's something I would be looking to do as well. All right. Dow Jones recovering almost 200 points of those 400 we saw coming off yesterday. Nasdaq almost giving a full engulfing candle right now, which would be a very bullish sign. If we can get up to where yesterday's open was, that would make it look very bullish. Inside of yesterday's is a little bit of a gray area, so you're going to have to keep that in mind as well. We need to have that kind of engulf or encapsulate yesterday's sell-off in order for it to really start to look very bullish. Then we've got the E-mini S&Ps, where it has pretty much encapsulated that whole sell-off yesterday as it's up 32 points on the day. But there's a gap there that we probably are going to be looking to cover. And now, just now, in this, since I started the daily market commentary, starting to see a little bit of weakness in the equities. It's the first time we've really seen it. You can see overnight was a mixed bag, maybe a little bit long. They flushed themselves out, but maybe got a little bit long coming into the day session, and no real attempt to flush those longs out, which is bullish, you guys. We haven't covered this gap. That might be something that we keep an eye on. I don't know that it'll happen today, but it is something definitely to keep an eye on. If that happened, we sold off very late in the day, that would be a little bit more concerning, that there was more downside, to be quite honest. So keep your eyes out for that. Now let's talk about the trades that I've done. We've had on this TLT trade for quite some time, actually, playing this out to the upside. I was expecting that we might see a little bit of a correction. I thought bonds were well oversold at these levels down here, and I was expecting it to come back to the sweet spot. Not necessarily expecting an inverted yield curve, but that definitely helped out on this trade, with TLT being slightly shorter duration than even the bonds that we usually look at with that /ZB. TLT is more shorter duration. It's the mid. It's closer to the 10-year, even though it's 20-year. It's got a bit of an average in there. So if you guys remember on this trade, with happened back on the 20th, so only December 20th. So we were back in here, this area, December 20th. Where can I find it? Right here. I expected that the interest rates were a little bit high and the bonds a little bit too low, or the 10-year a little bit too low, and the Fed wasn't going to do anything with interest rates. Well, you can see we've gotten that And, you know, I did this when there were lower lows, lower highs. It looked like it started breaking that pattern. We didn't get that lower low now. Now that's where you start to think, okay, maybe it is a little overdone as well. And this kind of lined up with the bonds. That was a Fibonacci as well. That just really signaled that it was starting to look like they were going to increase interest rates, which I do not think they are going to do. I don't think we're at a strong enough economy for them to even consider raising interest rates, and expected them to come back to what is the 160. This is about the 160 handle in the bonds, and we've blown by that, as you can see here, definitely outpacing even what the bonds did. So I had gone in there and done a risk reversal in there. So in the March, I did the March and sold the 132 puts in there, and then bought the 142 calls. That is a bullish risk reversal set up for all my rules. You need to go to protraderstrategies.com to sign up for that webinar to make sure you can understand all those rules in and around that. I did that for a 13-cent credit, all right? So basically, I need to get really up there, at least to the 142 handle, in order to get to my break even at expiration. Now, we don't really have to have that in that time. It acts like 50% of what I would have done if I would have gone out and just bought TLT or a synthetic long. A synthetic long is 100 deltas. I did it as a 50 delta trade, okay? So for every dollar move higher, I got basically 50 cents out of that. And I got a 13-cent credit. Well, I got out at a $3.55 credit. So all in all, my total credit is $3.68. Nice win on that trade. Went up, tested my 142. As a matter of fact, went through, as you can see here, to 144-ish, if you will. Today started seeing a little bit of weakness with the equity starting to rise. I decided to cut out of that trade, so I am out of that TLT trade for a nice win. Other than that, I haven't done anything. I am looking to cover my Disney short calls. We're starting to get a bit of a bounce here in Disney. Remember, I've got on the short 160 calls, but I have an earnings in here, and I'm fighting volatility expansion, which is hurting me a little bit. I've sold those for about $1.03. Right now, I think they're trading around 20 cents. So I'm going to be looking to cover that sometime today with this market moving higher. I don't want to really have this covered call trade on for that earnings for 20 cents. It really doesn't make sense. We could really see them knock it out of the park. Although I would like to get out sometime soon in this trade. I don't want to stay in it too much longer. It's just really not going in my direction, to be quite honest. So looking to cover all of that, but do want a trade that's gone against me. We're starting to see this where the market's starting to slide. I'm trying to lower my overall cost basis. I'm not selling puts in this because I really don't want to add to this trade. I want to just lower my overall basis and when we get back to basically where I got in, because it's so bearish right now and the overall outlook to me isn't that great, I'm going to look to cover this trade. So that's all I've done today. Going to be looking to cover these 160 calls in the February that I have for Disney, and that's about it. That's all I've got for you, other than if you can't take that, take it easy.